Welcome back, friends. So, inflation data is in focus in the coming week, beginning February 7, 2022. After a stunning jump in January, jobs numbers triggered speculation that a Federal Reserve could be more aggressive about raising interest rates. Already, as you are well aware, the Federal Reserve is behind the curve as far as inflation is concerned. The Consumer Price Index is reported on Thursday, and the headline number is expected at 7.2%, the hottest since 1982. And this is something which could again compel the Federal Reserve to act faster than was anticipated before. As you are well aware, Friday's report of 467,000 jobs added in January confounded Wall Street economists, some of whom had expected a negative number due to the impact of the Omicron COVID variant on the workforce. In fact, White House had also issued a clarification a little earlier that the jobs numbers could get obliterated by this Omicron variant, which had impacted the job market. So the Friday news was a little stunning in that regard. The report was also stunning in other ways. Payrolls were also revised higher by 709,000 jobs in November and December, and wages grew at a hot 5.7% year-over-year pace in January. Now everybody's back to playing leapfrog over each other to see how hawkish they can get about what the Fed's going to do, when the Fed probably doesn't even know itself. That's what many people believe. Traders in the futures market have begun to price in 6 interest rate hikes for this year, while many economists predict 4 or 5. So there is some disagreement regarding that. In this week beginning February 7, 2022, the Consumer Price Index is reported on Thursday, and the University of Michigan's Consumer Sentiment Survey is released on Friday. And not only that, there are also dozens of releases expected in this week ahead, including pharmaceutical names such as Pfizer and Amgen. Walt Disney reports, as do consumer staples like Coca-Cola, PepsiCo, and Kellogg. So we may get some sequential improvement in inflation readings. You start looking at the CPI on a month-over-month basis, and there may be movement in the right direction that way. Headline inflation is expected to rise by 0.4%, down from 0.5% in December. So month on month, you may see some improvement. So let's take that also with a grain of salt. Maybe movement in inflation in the right direction would be revelatory. I think it might take a bit out of some of the hawkish tone that the street has. Despite a sharp jump in bond yields and now nearing 2% 10-year Treasury yield, stocks ended Friday with gains for the week. Dow Jones slipped a little in the negative just before close, and you had Meta platforms fall more than 26% in one day on earnings disappointment, and PayPal also lost nearly 25% in a single session after issuing weak guidance. Amazon, on the other hand, jumped 13.5% after its earnings. So here we go. The type of volatility in individual names highlights the risk for investors in the top tech growth stocks that are among the largest names in the S&P 500. And it's extremely difficult for the investors, of course, who have only known how to make money for 15 consecutive years by owning growth stocks, to change how they view the world. So now the entire game field is going to change from growth stocks to value stocks. And the volatility we have seen around earnings in some of these names is not surprise, but it's exacerbated in an economy that is likely to grow north of 4%. So you can expect the cyclical and value stocks to perform better than growth names in an inflationary environment in which the central bank is raising interest rates. So S&P 500 rose 1.5%, as you know, in the past week, closing at 4,500, a key technical threshold. The Dow was up 1%, Nasdaq up 2.4% for the week. And energy was the best sector for the week, up nearly 5%, followed, of course, by consumer discretionary stocks up just under 4%. Financials were up 3.5% and tech was up 1%. Tech was languishing a little bit this week. And anyway, markets would remain volatile, as I said, this forthcoming week. Yields saw a big move on hawkish comments from European and UK central bankers this past week. And the move was extended even more after the Friday jobs report. We expect, of course, continued volatility, and which we have all seen in the individual stocks last week, and we both upside and downside, and that will make this week a very interesting one. All in the run-up to the momentous March 15 FOMC meeting where the interest rate hike could be considered. As you know, the US 10-year yield, which influences mortgages and other loans, has jumped as high as 1.93% on Friday. And however, there's another school of thought that the Federal Reserve need not be so hawkish and need not be so aggressive on interest rate hikes as the markets are forecasting. Because there's another school of thought that inflation could begin to peak and begin to come down as well. As we get to March, April, May, we could probably get to the point where the base effects start bring the year-over-year numbers down. Okay, so if the base effect starts coming in, then that could help very much. Okay, so this is how we look at the outlook for this particular week. Need to be extremely cautious, and of course everything on as a run up to the March 15 Fed meeting, which may trigger commencement of the interest rate hikes. In any event, as you know, the markets factor all this thing in advance, and therefore we may find it rather interesting to note that the Fed hike that may start getting it factored sooner rather than later. Inflation numbers will be definitely worse than what people are anticipating. The question and the moot point is how will this week, whether there'll be some more earnings surprises that may come in. We have more consumer discretionary stocks that are going to report earnings, and so they are not going to be as volatile as the tech earnings. Last week we had Facebook, Amazon, that was a different story. This week that will get tempered to that extent, and we will also begin to see some other interesting events. Ukrainian crisis, how much that gets impacted will be very clear this week. And there is another factor that if this Ukrainian crisis exacerbates in any way, then we have risk of trade once again. Also, you may face some challenges in the United Kingdom where there could be a change in the government. Now, Prime Minister Boris Johnson, having attended, they say, or half the, I would call it lockdown parties, and that's not a good sign for the Prime Minister and his, but then Rishi Sunak says that he attended one party as well. So anyway, I think clarity will start returning, but UK being an important economy, what happens there also can impact the world stock markets. All said and done, these inflation numbers emanating out of the United States will be the key to be watching for this week, and that will make it a very exciting week. How will each day span out? You can join Dow Jones, S&P 500 and Nasdaq group of mine, which is called Prime. And you can do that by Prime, Dow Jones, S&P, Nasdaq group. And you can do that by emailing me at globalmoneyinvestor@gmail.com. It is globalmoneyinvestor@gmail.com. Happy investing and have a real nice investing week ahead. Take care. Talk to you soon. Bye.